What is up, everybody? Welcome back to the Stock Trades YouTube channel. My name is Dan Kent, one of the co-founders of Stocktrades.ca. And in this video, I'm going to do a little bit of a quick turn again, and we're not going to focus on specific stocks. We're instead going to go over something that I think is quite possibly one of the biggest mistakes that beginner and even intermediate investors make when looking for dividend stocks. And that is misusing the payout ratios or applying the wrong dividend payout ratio to a specific company. If you're doing this, chances are in your pre-screens or even your in-depth analysis, you are missing out on some of the best dividend stocks in the country because of seemingly high payout ratios. So in this video, I'm going to go over the specific types of payout ratios and what type of payout ratio you should be applying to particular companies today to get the best out of your individual analysis. So with that being said, let's get started. The first payout ratio we're going to get into and why I feel it is not really a payout ratio that you want to use very often, that is the payout ratio in terms of earnings. So earnings per share, the earnings per share payout ratio is simply the company's earnings per share divided by its annual dividend paid. So if a company has an annual dividend of $2 per share and they earn $3 per share, they have a dividend payout ratio of 66%. And if we go even further to this, if a company has earnings per share of $2 and they pay an annual dividend of $4, they are paying out twice their earnings per share towards shareholders in the form of a dividend. But why is this not a very useful payout ratio to use when you're analyzing most companies? And when I say most companies, for example, banks, Canadian financial banks, actually any banks in the world, the payout ratio in terms of earnings is going to be the number one route to go. But if you're looking at a company, say a telecom company or a utility company or even a pipeline company, there is a chance that their payout ratios are going to be very, very high. And overall, to understand why this is actually happening and why these companies actually do have money to pay the dividend, but you don't think they do by looking at the payout ratio in terms of earnings, is because of non-cash items like depreciation or amortization. So a really quick overview: if you buy, as a company, you buy a piece of equipment for $10,000 and you choose to depreciate that equipment over the next 10 years, $1,000 a year. That $1,000 a year is going to come off of your net income from the income statement, but it actually does not cost the company any money in that specific year. Now, don't get me wrong, depreciation and amortization are real. They are real cash costs when it comes to a company's financials, but in terms of the health of the dividend and a company's ability to pay the dividend, it is something that typically bloats the earnings per share payout ratio. And the number one example I'm going to show you right now is a popular telecom company here in Canada, and that is BCE. So let's have a look at their income statement. So if we go to BCE's income statement, we can see the company had operating revenue of $22.88 billion. But if we head down the income statement, we can see that income statement depreciation and amortization were over $4 billion. We see that the company had income statement depreciation of around $3.475 billion and amortization of $929 million. Now, these are considered non-cash expenses. In this current year, it might have not actually cost the company any money, but it is still deducted from their net income. Now, as we move down the income statement, you're going to see a lot of different costs that end up coming off the company's bottom line, but we end up with net income of $2.634 billion. And if we move down to the earnings per share, we're going to see that BCE has diluted earnings of $2.76 in 2012. And if we consider the fact that the company pays a $3.50 dividend, that's simply not going to cut it, right? A $2.76 earnings with a $3.50 dividend, BCE must be borrowing or doing something to pay that dividend, right? No, it's these non-cash expenses like depreciation and amortization that is actually making earnings less. Profits are being reduced But the thing about it is that depreciation and amortization in the current year is not actually affecting the cash that the company is generating. So why exactly is there so much depreciation on the income statement of a company like BCE? And to figure this out, we can move to the company's balance sheet. And if we look to the balance sheet of a company like BCE, there's one thing that really stands out, and that is the fact that this company has $60.66 billion in assets. This is a company that has $80 billion in gross property, plant, and equipment, and net PP&E after depreciation and amortization, $27.5 billion in property, plant, and equipment. And as I mentioned, if you purchase PP&E, you need to depreciate it, and that comes off the income statement. And we can see that a company like BCE, in terms of their total assets, almost half of it is property, plant, and equipment. So depreciation and amortization in the end is eroding a telecom company like BCE's earnings per share. And this is why a lot of people, when they're quickly analyzing these companies, they're heading over to Yahoo Finance, they're seeing that BCE's payout ratio is way over 100%, and they're like, I'm not touching that, the dividend is going to be cut. But the key thing we need to do is to move on to a company like BCE's cash flow statement, because that is where you're truly going to see the cash on hand that the company has and why this dividend is very safe. So why is it critical to look at the cash flow statement? Well, because depreciation, amortization, and other non-cash expenses come out of earnings per share, they get added back into the cash flow statement to judge the overall cash flows of the company. And if we look to a company like BCE, we can see that in their cash flow statement, their net income is brought over from the income statement and put at the top of the cash flow statement. And as we move down this cash flow statement, you can see that non-cash expenses like depreciation, amortization, and depletion are added back. And when we get to the cash from operations, we can see that the company has $7.75 billion in cash flow. And in this cash flow statement, this is where we are going to calculate the free cash flow of the company. So we're going to take BCE's cash from operations, this $7.754 billion, and we are going to subtract CapEx, the net change in capital expenditures here at $4.288 billion. So after you do that, you're going to end up with free cash flows of $3.466 billion. So we've got $3.466 billion in free cash flow, which is essentially the money that a company has left over after they fund their business operations. Non-cash charges like depreciation and amortization are put back into free cash flow because in that current year, again, despite being subtracted from the income statement and the earnings per share, they don't actually cost the company any money in that year. And this is exactly why, again, if we return to BCE's income statement, the company has net income of $2.634 billion, but they have free cash flow of $3.46 billion. And if we look to a company like BCE, if we take this $3.46 billion and we divide it by the company's total shares outstanding of 905 million shares, we get a free cash flow per share of $3.82. So spinning back to BCE's annual dividend of $3.50 on an annual basis, you can see that the company does actually have the capital to pay its dividend despite its payout ratio being way over 100% in terms of earnings. If we look at a very capital intensive business like BCE with a lot of non-cash expenses on the income statement that are essentially decreasing net income, we can see that the free cash flow of the company is a much better use and a much better calculation to determine the company's overall dividend safety. And I have seen countless investors avoid Canadian telecom companies because they think that their payout ratios are too high. Payout ratios in terms of earnings don't work well with these types of companies. Now, BCE's payout ratio is still pretty high at 92% of free cash flow, but it is a lot better than the 120% plus in terms of earnings per share. So we've gone over the payout ratio in terms of earnings, we've gone over the payout ratio in terms of free cash flow, and we found out how to figure out free cash flow of a company. And one thing I forgot to mention in the calculation of free cash flow is you do have to subtract preferred dividends paid. I forgot to mention that at the start. But the free cash flow payout ratio is essentially going to be the payout ratio that I use to analyze a company's dividend at all times, except for a company like a bank. And that is because banks, in terms of cash flows, kind of operate in a weird way. They have a lot more cash outflows because they're essentially lending money. So really quick summary, if you're looking at a financial company, payout ratio in terms of earnings is going to be best. Like say you're looking at a Big Five bank here in Canada, trying to determine if the dividend is safe, earnings is going to be the way to go. But the next thing I'm going to focus on here is actually getting into something that really ends up stumping people, and that is pipelines. And we're going to go over the calculations here on the income statement and figuring out the cash flows, and you're going to find that actually both of them don't line up. So looking at a company like Enbridge, you're going to see that they have operating revenue of $39.09 billion. And if we get down to this net income, $3.36 billion. So diluted earnings per share of $1.48 in 2020. But Enbridge pays a $3.34 forward annual dividend rate. So we've determined that Enbridge's payout ratio is over 200%, but we're not going to skip looking at the company, right? We're going to dive in and we're going to check out the free cash flow of Enbridge to see if the dividend is well covered. So we take this net income from the income statement and we head over to the cash flow statement, and we can see that net income from Enbridge is at the top of this cash flow statement, and it's going to go down and add things back in like depreciation, amortization, as I had mentioned, these non-cash expenses, and we're going to get cash from operations of $9.781 billion. Now we're going to take the preferred dividends paid, which are back on the income statement, and we're going to take this net change in CAPEX down here, and we're going to subtract that to get the free cash flow of Enbridge, which comes in at $4.161 billion. Now, Enbridge pays a $3.34 dividend, and they have 2.026 billion shares outstanding. So if we take this $3.34 dividend and we multiply it by the total shares outstanding, we can see that the company pays $6.7 billion in common share dividends. So the company's paying out $6.7 billion in dividends, and as we figured out, the company has $4.1 billion in free cash flows. So we're getting to the same issue. Not only is Enbridge's dividend payout ratio in terms of earnings over 200%, but if we look to free cash flow, it's 161%. So this company is on the verge of a dividend cut, right? Well, actually not. Enbridge is one of the strongest dividend companies in Canada, and they've raised their dividend for over 25 straight years. So with a pipeline company like Enbridge, one that has so much capex, it tends to affect free cash flow. So these companies actually end up making up their own payout ratio, and they call this the distributable cash flow ratio. And what this ratio is going to tell you is that Enbridge's dividend is, despite these ridiculous payout ratios, still safe. So let's have a look at that. So the main thing you need to know with these midstream pipeline companies and possibly some capital intensive utilities is that the distributable cash flow is not a widely used metric, and as such, you're not going to find it on practically any investment website, Yahoo Finance, Reuters, all of that. They will not have it. This is something you either need to calculate yourself, which DCF is typically the EBITDA minus the interest, taxes, and maintenance capex, but essentially forget all of that. All you need to do is head to a company's investor relations page and check out their most recent quarterly filing presentation. For a company like Enbridge, Pembina Pipe, TC Energy, they're all more than likely going to have this calculation. And if we look to Enbridge's presentation, as we can see over here with distributable cash flow, we can see that the company had on the full year $9.44 billion, or full year of $4.67 per share in terms of distributable cash flow. And if we remember, Enbridge pays a dividend of $3.34. So again, we're sitting here with a company who has a high payout ratio in terms of earnings. They have a high payout ratio in terms of free cash flow. So what do? You look to something like this, especially if they're a pipeline or a capex heavy utility company, and you're going to be able to get these more accurate payout ratios. I don't know how many times I have seen people reiterate that Enbridge's dividend is not safe. This dividend is safe. All it takes is a little extra research. But finally, we're going to look into the last payout ratio, and that is the payout ratio that tends to be the one to look at for real estate investment trusts, and that is the payout ratio in terms of FFO, or funds from operations. Now, the first three payout ratios we talked about, you can make some mistakes in those and likely still get away with buying some pretty strong companies, but I can't reiterate enough how essentially useless the payout ratio in terms of earnings and free cash flow are when it comes to real estate investment trusts. REITs are a little bit different. They are structured tax-wise that they have to pay out the vast majority of profits back to shareholders. And the payout ratios in terms of earnings, I'm telling you, what you see on Yahoo Finance, what you see anywhere in terms of the dividend payout ratio is useless. It's not going to provide you with any reliable information. So funds from operations, what exactly is FFO and why is it so important for REITs? Well, if we look at this formula, funds from operations is essentially taking the net income, adding back the depreciation and amortization. Remember when we did that back in the free cash flow payout ratio? And we're also going to add back the losses on property sales, and then we're going to subtract the gains on sales of property, and we're going to subtract interest income, and the end result is going to be the most reliable thing that you can look at to judge a real estate investment trust dividend payout ratio. And the best part about it is most of these companies understand this, and they do list these payout ratios very clearly for even the average investor who has no idea what FFO is but knows it's important can read. And let's take a look at one of Canada's most popular REITs, and that is CAPREIT, Canadian Apartments REIT. We're going to see here the portfolio occupancy. We're going to see the net operating income margins. But if we get down to financial performance, you're going to see the FFO per unit of $2.25. Now, if we quickly look to what CAPREIT is paying on an annual basis, they're paying a forward annual dividend rate of $1.38. So if we calculate the payout ratio in terms of that, we get a payout ratio of 61.3%, indicating that Canadian Apartment REIT's payout ratio is more than safe at 61% of funds from operations. But if you were to go to Yahoo Finance and look up their payout ratio, you're going to see 25.5, and that is why you simply can't be using something like the payout ratio in terms of earnings. And CAPREIT takes it even a bit further and lists the FFO payout ratio right in their documents, so you don't even have to do the calculation. So everybody, that's pretty much it for the video. 4 key payout ratios: the dividend payout ratio in terms of earnings, the dividend payout ratio in terms of free cash flows, the essentially calculated distributable cash flow by midstream companies and heavy capex utility companies, and the dividend payout ratio in terms of funds from operations that you should be using when it comes to real estate investment trusts. All of these payout ratios have specific niches that they work well in. Again, I showed you the FCF payout ratio when it comes to BCE, a major telecom company. The payout ratio in terms of earnings is going to work very well with Canadian financial companies, or financial companies, period. DCF, again, midstream utility companies, and the FFO with REITs. I see too many people make way too many mistakes and they avoid very strong companies just because their dividend payout ratios are high. It's very important that you do your research and you don't skip over some great companies, or essentially invest in poor companies just because you have tunnel vision on a specific payout ratio, and it gives you somewhat of a confirmation bias as to whether or not the dividend is safe. Do your research, compare every single type of payout ratio towards each other, towards the industry, to understand if you have invested in a company that has a dividend that is well covered and set to grow. Again, smash that like button and drop a comment down below. Let us know what you want to see next. This was a heavily requested video, and that is why we made it, but we will never know what to make if we don't hear from you. And until then, stay tuned for more great investment content, and we'll see you next time.